Hi, and welcome to Macro Wednesday, where we talk macro, trying to make sense of markets that, they don't make any sense. But more importantly, answer your questions so we can become better investors. I'm your host, Steven Van Metre, and thanks for joining me today. I've got a great show lined up for you. And as we expect, hey, stocks are up today. And what do you know? Treasury yields were up a little bit too. Funny how the two work together. But remember, as we will continue to look at, the big move is yields headed lower. What does that mean? Well, if you kind of figured it out, that means stocks are eventually headed down. We're going to take some time, look at the charts, look at how hedge funds are positioned. But first, I want to get into the economic data, and hopefully we'll have some time for your questions because you've sent quite a bit. I've got some great questions for you, that you sent me. So great questions you sent me. Let's go back to Monday in the economic data. Now, there's not a lot of data out this week. I don't know why, if this week of all weeks, there's just not a ton of data. But let's go back to Monday, the Australian AIG Services Index. This is, again, like the factory PMIs, month-to-month showing further contraction in the Australian services sector, and that's not too good. Looking into Tuesday, the leading index in Japan, still no major improvement on a month-over-month basis. This is May, so leading index preliminary just shows no improvement in the Japanese economy, and whatever's going on over there, it's bad. It's bad. Now, how about some good news? I keep thinking that France is the cleanest shirt in the European Union's laundry basket, and at least from exports and imports, both exports and imports rose. So that usually when you see an expanding economy, you want to see exports and imports both rising. So don't know what's going on over there, but it gives us an indication that something good at least is going on in the global economy. Moving on into the U.S. data, on Wednesday we had Redbook weekly same-store retail sales. Now what's interesting about Redbook, it does not include online sales. It is brick and mortar, and on a month-over-month basis, this is, again, since it's weekly, it still is down minus 0.6%. And on a year-over-year basis, it went from minus 5.7 last week to minus 6.9%. If we click this and open it up, we can see the chart. And you can see on same-store brick and mortar sales not budging. And zooming out, it's worse than it was during the great financial crisis. Remember, everybody thinks the worst is behind us. They look at the stock market and say, man, the economy is just going to boom and go. And Redbook says, no, things are actually really, really bad in the retail sector. I think in the end of the day, Redbook is right. We'll see. The job openings and labor turnover survey showed that there were 5.397 million job openings in May as lots of people hit the unemployment line. Kind of interesting, but nevertheless, that the Fed does like the JOLTS data. This was Janet Yellen's, maybe still is her favorite data point, at least when she was Fed chair, it was. So it's showing that even though workers were headed home, employers were still looking to hire, at least back in May. Moving on to the 3-year Treasury note auction was met with very strong demand. I know we don't often talk about auctions, but what I found interesting is the Fed doesn't buy a lot of 3-year Treasury notes as part of their QE package. But nevertheless, the auction went very well, brought interest rates down that day. Moving into today, we have mortgage applications rose 2.2%, led by purchase applications as refinance applications remain pretty weak at plus 0.4%. Remember, the mortgage or the residential real estate market is key to the growth of our economy, and the lending data shows on a quarterly basis or a 3-month basis it's headed negative. Maybe it'll print negative this week, but it's bad, and this is not showing the hope that we need there. We need people to pull money out of their homes and go buy lots of stuff, and we're not seeing it there. How about we move into crude oil today? And what a shock. The market was expecting a 3 million draw, and they set the bar pretty low because this is the time of the year that you want to see large crude oil draws. And what did we see? A 5.6 million barrel build. Bad news. Although oil closed higher on the day, as if the market kind of blew this right off. Looking at Cushing, Oklahoma, build of 2.2 million barrels. Distillate stocks plus 3.1 million barrels. That's, again, this should be drawing down because normally people are traveling and a lot of distillate, it turns into jet fuel. So we're obviously not seeing airplanes flying around as much. So this is, again, bad news. The only good news I found in the report is gasoline inventories fell 4.8 million barrels, as at least Americans were apparently out renting RVs and at least driving around a bit more. Overall, though, when you look at crude, distillate, and gasoline inventories, they're all over their 5-year average, and that is bad news because if this doesn't start drawing down massively going into the fall, it's not going anywhere. It's going to go back up, and these levels are already high. Today's 10-year Treasury note auction was met with very strong demand. And I want to take a look at this. I know we normally don't do this, but here we are on the Treasury Direct website, and we can look at today's auction results. And I want to look at the 10-year Treasury. We'll click on Note, click on 10-year, and you can go to Competitive Results. And these are released shortly after 10 a.m. Pacific. And you click on the PDF, and it opens up. And I'll zoom it out a little bit. And you can see here's the auction. So there was $29 billion auction today. And primary dealers, these are securities dealers. Direct bidders are domestic, U.S., and indirect are foreign bidders. Now, the reason I bothered to look at this, well, I do look at it every auction anyways, because I post it. If you follow me on Facebook or LinkedIn or go to my website, you'll see there's a daily market brief where I put this information in when it's released every day. And the primary dealers picked up $5.8 billion of the auction. Now, why is that interesting to me? Well, because I want to go look at what the Fed is buying. And what was strong about this auction is domestic bidders and foreign bidders picked up a pretty decent chunk. So primary dealers at $5.7 billion, the way I interpret this, and I'm not suggesting that what I'm going to tell you is exactly right or wrong, but I assume that this entire amount is going to get flipped over to the large commercial banks, who are in turn going to sell it to the Fed at some upcoming QE auction. So that's kind of how I view this. And what I'm looking for to see is, as the security dealers take this new inventory, presumably flip it all over to the commercial banks, is that new inventory more or less than what the Fed is coming along and chewing up? So let's go to the New York Fed website and just kind of take a look. So I'm just at the newyorkfed.org. Under Markets and Policy Implementation, you can go to Treasury Securities. And over here on the right, you'll see Treasury Operations Schedule. And I'm not going to go through the whole month, but let's just go back and look at, let's see, 626. So last Friday to, so the next, this is a 2-week period. So let's look where they're going to buy these potentially buy these 10 years. Well, here's one, 7 to 20 year. And these are Treasury inflation protected securities. So here, the Fed's going to buy did buy on the first $3.6 billion of what would float into 10-year Treasuries, because between 7 and 20 is, 10 years and 20 years maturity bonds. Now, the Fed, we're going to say, is going to buy this at least twice a month, maybe 3 times. And if over here we find there's $5.7 billion, here's 3.6, you can see that the Fed has a high probability of buying up more than the supply that's coming in new issuance. So this is how, when I talk about the Fed puts downward pressure or can even cause interest rates to go down through QE, it's just by taking it off the market. So they're just buying up all the supply. And you say, well, how does that make it go down? All right, well, simple. So the large commercial banks need to have reserves to auction off to the Fed, because the Fed is going to force the purchase of this QE. There's only been one time in history where the Fed didn't buy their whole, that I know of, that the Fed did not buy one entire auction. They bought a fraction of it. So the Fed's coming in and they're going to buy. Let's say the large commercial bank is short on inventory. Now, when they're short on inventory, where are they going to go? Well, they're going to go to the securities dealer. right? I mean, when you're short of something, what do? You go, hey, I think I'll go to the store and buy some. You're not like, I think I'll go onto Facebook or somewhere and be like, hey, I'm short a bunch of something. Who wants to offer what they got, and I'll buy from the highest bidder? No, that's not how it works. You go to the store and you buy some. So where are the commercial banks going to go? They're going to go to the securities dealer and say, hey, we need you to go get us some more of these Treasury notes because we're a little short and the Fed's coming up and we need to buy some, or we need to sell them some. So we need to get some to sell to them. Kind of makes sense now. I'm getting confused. Anyhow, so the securities dealers, they have to go out to the market and get them. And when they go out and become a buyer, they push yields down. And that is how QE leads to lower, not higher interest rates, because when the Fed does enough, it puts downward pressure on it. So I thought that was pretty interesting. Looking at the auction tomorrow, you can go here and find the 30-year auction data, and there's probably some interesting stuff there. We'll see how that auction goes. So the 3-year auction was strong. The 10-year auction was strong. And with some hope, the 30-year auction will be strong. The May consumer credit data fell $18 billion. We already know this because we look at the weekly credit data, so no surprise here. Consumers are still paying down their credit cards, and you're not going to get a recovery in the U.S. economy until consumers start to charge and buy a bunch of stuff that they don't need. That is obviously critical in the big picture of things. Let's take a look at how hedge fund managers are positioned in the market. Now, again, this is delayed. Normally this comes out on Monday, but due to Friday being a holiday, this did not come out until, I believe, sometime on Monday. So looking at speculative positions on 10-year treasuries, we see for pretty much, they were slightly long 2 out of the last 3 weeks, but really now we see hedge funds starting to take a long position. And yields do not bottom until hedge funds are long. Now you go, oh, well, they're long now. No, when they're convincingly long, here or here, not this little bit, but when they're long, yields bottom. So yields have not quite bottomed yet. They still have more to go. How about the 30-year yield? I got a number of questions about why did Treasury yields rise recently on the long bond? Well, look, speculators or hedge funds took a larger short position. In fact, they're back near one of their largest short positions on the 30-year bond in history. So this is the longest, second longest, and darn near close to the second longest. So they increased their short positions. That would put upward pressure on Treasury yields. How about West Texas Intermediate? We see speculators are backing off a little bit more on their long positions. Crude oil seems to be stuck around 40 a barrel. Obviously, it's not at 40 a barrel. There just isn't enough demand. So that's telling us crude oil price is still too high. Need to see prices dropped and that inventory levels come way down. How about S&P 500 futures? You want to know what's driving the market back up recently? Look at how hedge funds have backed way off their short positions and caused the market to move higher. How about gold? Everybody's now super bullish on gold due to inflation. Again, I'm on the other side of that fence. I'm not short gold. I'm not taking a position against it. I believe gold is overvalued. I believe it's a massively crowded trade. And I believe real yields will prove right when consumer prices are eventually released this month and in the months to come to show there is actually deflation. But hedge funds and other speculators increased their long positions a little last month. Silver is not validating this. We've looked at that before. Emerging markets not really validating it either. How about tech stocks? Everybody loves tech. After all, it pretty much is the entire stock market these days, running down to 5 tech companies, and hedge funds have increased their long positions as everybody believes that this thing is just going to continue to go vertical forever, because that's how stocks actually work. How about small caps? Small caps, remember, lead the large caps. Hedge funds are still long slightly, but small caps are not validating the big boys. How about the U.S. dollar? If you want to look at any reason why gold has been going up, it's because of the dollar. Look at how hedge funds have taken their dollar long. Remember I said before that it doesn't make sense that the hedge funds were long the dollar if they're so bullish on gold? Well, I guess they figured that out. They're now short the dollar, bringing the dollar back down a bit, and that's putting some upward price mobility into gold. And how about volatility? Hedge funds are still short volatility, as I think we're getting close to volatility breaking higher. And with that, let's go take a look at some charts and see what we can glean from there. All right, here we have the S&P 500 sitting just over this kind of trend line. Remember, if prices start to fall below there, it risks squeezing all of these people who are longs and causing them to exit their positions. So constructively, the S&P 500 is holding up here. From a different picture, let's look at symbol SPY, the ETF of it, because I've got a little different picture. Here we have that massive megaphone pattern, and you can see prices are just flirting right around the top of this. And if this breaks down, it suggests that we're headed below this roughly 2100 level here and potentially even lower. The megaphone patterns are consolidation patterns. They either indicate prices, if breaking above the megaphone, so like we saw here, suggests that we're off to a massive move higher. And if below the megaphone, says they're headed much lower. So this is a consolidation pattern, but how it ends? Well, the market's trying to get it up there, but so far, nothing conclusive. How about the NASDAQ? Obviously, everybody loves tech. Tech companies are going to go to the moon. The whole NASDAQ will be 5 companies in a matter of, probably a couple of months, because all the other companies are going to be pushed out of the way. So yeah, everybody, you look at 90% of Americans, their household wealth is tied up in 5 companies in the NASDAQ. That is insane. How about the Dow not confirming the NASDAQ at all, stuck under its 200-day moving average? How about the Russell 2000? It held its trend line today. Small caps risking a potential move lower, dragging the large caps with it. In terms of volatility, and we've looked at this, but I'll zoom out. You can see right around this 31 level where I've got this line, it seems that volatility likes to break up when it breaks through 31. Now, remember, not too long ago, volatility was trading in the teens, and then it shot up. Imagine now where volatility goes if it doesn't get all the way set back down. So it's pulled back, but volatility is still relatively high given where stock prices are, suggesting that if volatility breaks through here and gets out of the bag and gets running, it could probably break through its prior high, suggesting, again, a much larger move lower in equity prices. Stock bulls really want the VIX to be right back down here around 15 or 10 to 15. And the danger zone, I think, is right above 31, and that gets out of control. How about 5-year Treasury yields flirting with their trend line, looking to break lower and potentially head negative, which I have and will maintain my prediction on. How about 10-year Treasuries? They're under their trend line. After today's 10-year Treasury auction, they headed lower and are looking to continue that trend as they're below all their major moving averages. How about the 30-year, the long bond? It too closed lower. And notice how the long bond, now this isn't something that all happens all the time, but the 100-day moving average, kind of 100-year moving average, that would be insane. 100-day moving average and the 50-day moving average were converging. Now, normally, when you see a rally moving up, you want to see it cross the 50-day, confirm it, and then go. Well, in this case, the 100-day moving average acted as a level of resistance, and right now it's suggesting that 30-year, the long bond, and we'll be interested to see how tomorrow's auction goes, is now that it's sitting under 1.4, is looking like it should retest its all-time lows. And we can go to the inverse of the 30-year yield in stock ticker world and look at TLT, which is the largest long-term treasury bond ETF, and we can see it's holding over its 50-day moving average. You can barely see it. It's in the sell zone. This is where sellers have been dominating in this level up here. I'm going to clear this off again. Maybe this time it'll stick. And you can see its 50-day was converging with its 100-day moving average. And again, it crossed out of this consolidation channel and is moving up just like it did back down here. And think of this like a springboard. It pulls down and then springs higher as it squeezes out these people who are short the bond market. And let's go in and look, because I want to show you the midnight sellers, and I find this very interesting. And we go back in the last 10 days and we've seen selling in the overnight, And the overnight's this light shaded blue area. Now we saw some buying here, but selling in the overnight here with some buying later, selling in the overnight, some selling in the overnight that rose and then started selling in the overnight into open, selling in the overnight, selling overnight, the midnight sellers, and here we already see an after hours trading. Now, who knows if this will stick, but you see selling here. So whoever is selling continues to do it. We'll call it in the midnight hour. But as they continue to be squeezed, the Fed continues to buy and deflation continues to occur. This is more likely to break out if this gets above where this line is here, which is roughly 1.2% on the 30-year. You've got the next leg higher. It should blow right through this onto the next level. Let's look at financials. Where are you? XLF up here. Let's look at energy first. Energy breaking through this short-term hopping pattern. And, that seems to me to suggest that everyone that was bullish on energy, guess what? If you liked energy stocks down here, you're probably going to see them lower. And I'll take that one step further. We can look at ExxonMobil, which is the largest position in XLE, and you can see it's breaking through. It's heading through this topping pattern as well, suggesting ExxonMobil is going to be under $30 a share. Wow. Go find someone that's worked for ExxonMobil for a long time and ask them. They're still impressed that it's this low. But crude oil is sitting at 40 a barrel. It's got a rising trend line too that could also end up being broken. Obviously, with these inventory builds, it just doesn't look good for crude at all. Now back to the financials, which are generally the inverse of the bond market. Now, why is the financial stock so interesting? Well, I'll tell you why. Glad you really asked. Is what do we know about the banks? What happened recently? Well, there was a stress test. Did they pass? No, they failed, which is odd because it's pretty much an open book test. So the banks already knew ahead of time they were going to fail. So what did they do before July? They started increasing. They were already buying Treasury securities, but they really ramped them up. Remember, they just started boom, 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 buying. So they knew they were going to fail the test because the Fed effectively says, here's a test and here's the answer key. And they already knew going into the end of the second quarter what the penalty was. And what was the penalty? You can't buy your stock back anymore. So what was happening is the large commercial banks, by buying their stock back, were putting upward pressure on yields. At the same time, the Fed was doing QE and putting downward pressure on. Now, without stock buybacks, for at least the next quarter, probably longer, but next quarter for sure. I can't imagine things get better for the commercial banks in the next quarter, or the economy. But it puts downward pressure on yields, and that's all of a sudden, hey, does it make sense why they're picking up their inventory of bonds? Yeah, because they also know that tighter or lower Treasury yields equals tighter financial conditions, which means the Fed's going to have to do what with their quantitative easing program? Bullish. They're going to have to do more, and they're going to buy it off large commercial banks for a profit. What are the charts telling us in the Treasury yields? They're telling us they're breaking lower. They're telling us financial conditions are tightening. They're telling us that whatever everyone thinks about the economy, they're wrong. It's bad. It's worse than the market is telling them. And all financial stocks here are doing is validating that, suggesting if you like financial stocks at $17 a share back here, you're probably going to love them when they're even cheaper. And you say, well, they can't be that closely related. Yeah. Let's take a look. Help if I clicked on the right spot, wouldn't it? How about compare with TNX, 10-year Treasury yields? Huh. Look at that. They kind of moved together. Probably this is actually closer to the 30-year, isn't it? Let's go and put it on for fun. And that is TYX. Yeah, there you go. Much more closer to the 30-year. So there you see it. There is a relationship between the two. Treasury yields are headed lower, dragging bank stocks lower, and you can guess where that takes the rest of the market with it. So again, if you're bullish on bank stocks and you're bullish on treasuries, you've got it backwards. If you're bullish on treasuries, you don't want to be bullish on bank stocks at all. All right, let's see. Emerging markets kind of got over this. There's a lot going on in emerging markets. It's trying to play catch up here, but I'm still not convinced that the liquidity conditions are back and this is not a blow off top in the markets coming in at all, because silver is still way below everything. So I kind of get a feeling that things are going to turn around here. How about high yield bonds? We haven't looked at this. Remember, the Fed's buying these things. And look, they broke below their upward trend line. The Fed's buying, I think, 300 billion. No, I forget how many they're buying. But anyways, look, the Fed started buying over here. Remember, the announcement was here, popped up here. I thought this was bullish for high yields. Doesn't appear that way at all. How about this? Let's wrap this part up with the dollar, and we'll get into your questions. In the dollar, after finding resistance at 90, almost just under 90, high 97s, is back down into the buy zone in the $96 range. So we'll see if buyers can come in and push that back up. This is really what's driving gold in emerging markets. I don't believe it's really a whole lot else. All right, on to your questions. And thanks so much for your show. Informative and entertaining. Hey, you're very welcome. I always fell asleep in econ class. Now I'm riveted. Shows you what having money at stake can do, I guess. That will always really do it, So it's like someone who's been on a sport event. It's like they might not be interested. The moment they put money down, all of a sudden they're glued to the TV set or wherever. But the same is true with this. Obviously, you're long bonds, and I think I understand most of the reasons why that you present. Okay, yes, so that's good. I am long bonds. I do notice, however, that the plunge in March took bonds with it. I assume that's because of the dollar shortage, yes, and the generalized panic. Correct me if I'm wrong. Yeah, that was the dollar shortage. There was a liquidity crisis. In the upcoming plunge, wouldn't this occur again? If not, why not? I can't answer. The other party here is because it's investment advice. Why? Because where's the charts? So going into March, yields went way down. A lot of people thought this was the bottom. So there were money managers and investors that sold here. There were hedge funds and other people that shorted here, and they pushed it back up. This time, it's getting ready to break down again. So it looks like it'll go down. Now, will it pop back up probably like this again? Yeah, I think it will, but it doesn't mean that there won't be a very sharp, deep move lower in what could be a generational bottom in Treasury. It may not be, but it's going to be pretty darn close. So no, I don't think that happens again. I think we get the move down and then maybe a move after higher, but I do believe there will be a move lower. And the charts are telling us that. That's why I think it's so important to do technical analysis with macro, because the charts actually do validate or tell you you're wrong. Hi again, and thanks for your great show. Hey, thank you. You're very welcome. Could you clarify what you meant about Jerome Powell's mistake? I think it's because my brain has a problem with double negatives, but basically my misunderstanding is this. In what sense is his recent pullback on QE a mistake if it doesn't do what anybody thinks it does? Is it a mistake because it will cause yields to rise, which is the opposite of what the economy needs? Or is it a mistake because it will freak out the market? Freak the market out because the market misunderstands QE as a liquidity injection, but if the latter isn't QE what causes low yields and stocks to go lower with lower yield. How again do low yields cause lower stock prices, or if not cause, why are they correlated? Anyway, my thinking is obviously confused in this matter, and I think I'm confused with you. Please help. All right, well, let's talk about what the problem was. Okay, the economy is a patient. The economy has been in a car wreck and then been stomped on, right? It was already heading recession, and then the coronavirus comes along and it's in bad shape. It gets hauled off to the ER. Yeah, I talked to a friend of mine today who's an ER doc, so we're going to get examples about doctors today. All right, so here's the U.S. economy, the global economy, laying it. We'll just stick with the U.S. economy, laying in the OR, trampled, beat up. Blood. This thing is just a disaster zone. And Doc comes in and says, "Oh man, economy. Well, this is Fed chair. Powell comes to, man, economy, you're in bad shape. Think I'll do a whole bunch of QE. Oh, his vitals are slightly increasing. Okay, I'm going to back off and I'm going to go have some coffee and maybe get a bite to eat. I'll be back a bit later. Look, the patient is dying on the table. The U.S. economy, which is going to drive the global economy, is dying on the table. In a debt-based economy, you need the debt to grow. That's how it works. Debt grows, economy grows. Not exactly, but that's generally how it works. The debt contracts, the economy is going to contract. So what Powell needed to do was drive interest rates effectively to zero and keep them there. And just keep them there until the economy came back. And so what did he do? He drove them down, or the market drove them down. Then the market pushed him back up. Then he brought him down and stepped away. Is that helping any? No. That's why we look at the data on Friday. What's happening with the credit data? In some places it's contracting, and everywhere else it's massively decelerating on its way to contraction. So what does it tell us? His big mistake was he just didn't do enough. By not doing enough, the patient is getting worse on the table. It's not like while the economy is laying there in the OR, that's like, hey man, it's getting better. No, it's getting worse because the longer you wait to treat it, other things go wrong. And it just means the next round of QE, the next drug injection or whatever the Fed, Powell's going to do to the economy is going to be bigger and bolder than the last time and totally validate my view that interest rates are headed lower. And when financial conditions are tight, stocks go down. That's what it means. That's why they're related together. Because low treasury yields are a sign of deflation, disinflation or deflation. And that means prices go down. Asset prices go down. What are stocks? Assets. They go down. So you go, why are they going up? Because everyone's betting on inflation. They're wrong. The Fed causes deflation. The Fed has to deflate the economy to reinflate it. And it sounds really stupid. It was like, wait a minute, I got to deflate the balloon to reinflate it? Yep. I know. This is part of this. Doesn't make sense, Pitt? Yeah, that's what I mean. It doesn't make sense, but it's actually how it works. So the Fed is going to tighten financial conditions, cause deflation by doing more QE. It's going to lead to a crash in stock prices, just like the GFC, in order to reinflate it as people start borrowing. So the mistake Fed Chair Powell made was he didn't do enough QE, and he should have done more. But he's watching the stock market. He's getting nervous. He's watching the economic data. He's getting a little nervous. And, well, he's going to be wrong. And that means he's only going to have to do more. And it means the economy is going to be in worse shape for longer. And with that, we will wrap up today's show. And I appreciate you being here and taking the time to watch. And we will be back on Friday to look at the data. The Friday data is fantastic. We'll catch up on the stuff between now and then and the economic data, which there isn't a ton, and we'll get to more of your questions. Anyways, thanks for being part of the show, and thanks for being with me here today. I'm Steve Van Metre. Bye now. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. It is not to be construed as a recommendation or solicitation by selling security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.